Welcome back. Well, the good news is the markets have recovered all of the losses. We're almost moved into the green. And as we said earlier, the Nifty needs to move higher. The Nifty Bank will have to do bulk of the heavy lifting because the IT index is under the weather today. And as we speak, the Nifty Bank is now up close to around 400 points, building onto its gains. And it's only approximately 2% away from an all-time high. So good going on the Nifty Bank. Ben Powell, Chief Middle East and APAC Investment Strategist at BlackRock Investment Institute, joins us on the show. Hi, Ben. Good morning and good to see you, Ben. Well, what are you making of the news flow? There's hope that there's going to be some kind of rationality that will come about. President Trump, as well as the Japanese, are having a discussion. A lot of comments coming in from the Chinese as well. And then you have news that various parts of America are looking at suing President Trump because of these tariffs. So a lot of news flow. Do you think things will get better from here on? Rationality will come about and the world moves forward?
Good morning. I think rationality is a high bar. I think we live in an emotional era. President Trump has talked extensively about how he feels for many years or decades America has been exploited by the rest of the world. And now, to some degree, it's payback time. So I think there's more to life than pure rationality, and politics inherently is somewhat emotional. So that's normal, and that's going to continue. That does confuse our lives in markets where we are, kind of always looking for a pure, clean, quantitative answer. It's going to be messier than that. We did think at BlackRock last week was very important, specifically where it seems that there are some constraints on the US administration. So they were, I think, a little bit worried by, in particular, the move higher in US Treasury yields. That, I think, was disconcerting to them. And since then, we've seen them adopt somewhat more of a positive approach bilaterally, as you're saying, including with big countries like Japan, India to come soon, we all hope. So I think there are things to be more positive about. There is a constraint, which is good to know, but I don't think we're going to have a purely reasonable kind of market or economic backdrop, because it's a time for kind of passion, and I think that's going to continue.
Oh, absolutely. I mean, we're still watching for all of those headlines and those social media posts, right, Ben? This morning he says that it's been, I think, a great meeting with the Japanese delegation. So let's see what the eventual outcomes will be like. But from a market perspective, first basic question, is the worst of the price damage over? Has a floor been put in place around global markets, equities?
So we're overweight the US, and the US obviously is the huge bulk of global equities. So if you don't mind, I'll speak to the US as an answer to your question.
Yes.
Look, we think there is something, as I mentioned last week, was very important. That Trump, who has signaled, I think, that he's much more interested in Main Street than in Wall Street. That was very worrying for equity markets. But he is constrained, it would appear, by the bond market. So I think that was really important information that we got. That's the first thing. The second thing is there's still a lot to be positive about at this time, including the AI megaforce, some earnings growth stories that we favor. So, again, a lot to worry about, many things that are for sure kind of uncertain, but we shouldn't throw the baby out with the bathwater. There are still significant tailwinds that are out there, and we need to remind ourselves of that before we all become a little bit too emotional ourselves, I guess, and too kind of worried about the bad things, of which there are many, but there are some good things as well. So in conclusion, we actually, we're overweight US equities. We think valuation is sufficiently cheap now that we can start to carefully pick our spots as to where we want to be more positive. And again, AI continues to be a very powerful tail force, we think, and clearly America and other markets, but in particular America, is a way to play that.
All right. So, Ben, you're saying that you'll stick to the U.S. markets. What commentary we've been hearing over the recent past is the dollar index got a little bit more weaker. Trump still has the problem with regard to deficit. So something's got to give out there. So we could see some money flowing to emerging markets. But you're saying that you still believe that the U.S. market will outperform even from here on. Is that correct?
We're overweight the US, that's true. But I think implicit in your question, Nigel, is something super important, which is that we are moving to a much more fractured world, sadly, I would say, but that just seems to be true. And as investors, we need to reflect what's true rather than what we maybe would prefer to happen. So what seems to be true is the world is fracturing geopolitically. And as investors, that should mean less correlation in equities markets in particular. So in the calmer times, you could just be so-called risk on, right? You could sort of just buy the S&P, and that was a proxy for global risk, and that was sort of sufficient. Now, we think you, as investors, we're all going to have to be a lot more granular, a lot more kind of specific in exactly what risks we want in the portfolio. And that includes certain geographies outside of America. So I would highlight Japan as one. I'd highlight maybe India as another. But the broader point is, yes, we still like the US, but in a fractured world, we're going to need to be kind of more expansive and think beyond the US as to particular areas of the market, the global market, that we think can do relatively or even absolutely okay as part of this fractured, more fractured world.
Interesting. So you have to diversify risk, basically, and look at some of the other markets as well, like you're saying. Ben, on a side note, I mean, gold has been such a stellar show this year, right? I mean, if you look at the targets, I think most of the big Wall Street banks, they still have targets northwards of 3,500 USD. I saw one, I think it was Goldman Sachs, saying 4,000 plus. Do you think gold will still keep drawing in this kind of fund flow?
I think so, yes. I mean, look, gold has got a 6,000-year track record of being the diversifying asset, maybe all the time, but particularly in times of uncertainty. And heaven knows we've got one of those right now. So yes, it does feel like a time for gold. We'd only want to have a certain proportion of that in the portfolio. So, you know, again, obviously at BlackRock, the world's largest asset manager, we would always sing the song of diversification. I think that's like very important. But as part of that, gold continues to do well. And I think, again, over a very long period of time, the benefits of having some exposure to gold as part of a well-diversified portfolio, in particular during volatile moments, I think are well established, and we think that's going to continue. So yes, a lot of merit for gold in the broader portfolio.
And speaking of diversification, you mentioned the bond market, right, which I think finally forced the U.S. president's hand. That little drama that played out that finally perhaps made the U.S. administration back up a bit. Was that just a one-day event? We remember that surge, right? U.S. 10-year suddenly was shooting up to 4.5%. Conspiracy theories about whether China is selling treasuries or Japan is selling treasuries. Do you expect more of that? Because that's where markets really get rattled.
We expect more of that, yes. I think we're in the midst of a global rate reset higher, driven by inflation, which, as Chair Powell was saying overnight, continues to be much too high already. And that's before the inflationary impacts of tariffs start to feed through. So we're likely to be moving into, indeed, at BlackRock, we would say we are already in a structurally higher inflation environment. That has implications for the Fed. Simply put, they can't come in and save the day. And then to your question, that also has implications for longer-term interest rates, which we think should, over time, move higher. So you're exactly right. We had a particularly kind of exciting, dramatic moment last week, which for sure we need to focus on. But it's actually a bigger story than that for us at BlackRock. It's a part of a structural trend higher in interest rates, driven by higher inflation, which we think is going to continue, and actually is only going to be exacerbated by the tariff, the inflationary consequences of tariffs.
All right, Ben, I want to ask you, what do you make of Powell's statements overnight? You know, he said that they've got a tougher job than they were earlier thought about. And did he put to rest any kind of Fed put? What was your reading of what he said overnight?
Yeah, I think so. Look, I thought he spoke truth, right? He said, look, inflation's a bit high. I'm going to paraphrase here, but he said, look, inflation's a bit high, and that's a constraint. So the Fed has a dual mandate. And I always want to be really clear. Mandate means mandatory. It means they don't have a choice. Their mandate is given to them by Congress, and they do not have an opt-out clause, right? It's mandatory. And the dual aspect, one, kind of employment growth, two, inflation. So Powell, I thought, was just reminding us of that. And therefore saying, look, the inflation side is already a bit high. tariffs are inflationary. That's a non-political, non-controversial statement. That's just true. And therefore, the Fed is going to be somewhat constrained in how much it can come in and bail us out if there is a growth or market problem. So there is a Fed put, but the strike is probably a lot lower than we would all like. And we are not close, I think, to that Fed put. So Powell, I thought, spoke very well, very clearly, as he tends to do, reminding us about the binding nature of both sides of the mandate, and in particular inflation, which is just too high and potentially going higher as the ramifications of tariffs work through.
You're saying that you would not be surprised if U.S. rates head higher, inflation. How much higher, Ben? Do you have some sort of a range in mind, 10-year?
Yeah, so we think ultimately that it's reasonable to think over time that the 10-year can start with a 5 handle. That seems totally reasonable to us. And that is potentially a real kind of issue for a U.S. administration and a U.S. economy that's obviously got substantial amounts of debt. One kind of really interesting aspect of this, by the way, is like 30% of that debt is owned by foreigners. So it's quite an interesting aspect. You know, President Trump seems to be moving towards, as he said many times, an America First policy approach. You know, sure, that's fine, but it's also true that 30% of your funding comes from foreigners. So I'm going to be very interested to see how the U.S. administration squares that circle of being, as they've said, America First, but I guess also being somewhat friendly for the overseas funding, which has been such an important part of U.S. growth and exceptionalism, I think, over the last many years and decades.
Well, indeed, Ben, it's going to be very, very interesting with regard to how he rolls over as well part of that debt at a higher interest rate, and as they're running a big deficit number out there. So interesting times. We'll keep an eye out on the markets, but also I think the bond markets, they deserve special attention. Thanks a lot for joining in. Always appreciate your comments here on CNBC-TV18. Well, time before we slip into that break, let's get Mitesh back in. Mitesh.